For Morningstar, I'm Jeremy Glazer. Immediately after the election, the equity market seemed to be in focus, but in the past couple of days, the bond market has really been on the top of investors' minds. I'm here with Sarah Bush. She's our Director of Fixed Income Manager Research for North America, and we're going to look at how some bond funds have performed. Sarah, thanks for joining me.
Thanks for having me, Jeremy.
So let's talk about what's happened with the yield curve and what you think is behind some of these relatively big moves.
Right, so we have seen a continuation of a trend really that's been going on since July when the 10-year Treasury bottomed in yield. So we've seen yields go up across the curve, and that really accelerated with the election, a big jump in the days after the election. So rising yields mean losses for bond funds, and we've seen losses across a number of bond fund categories, and we'll talk a little bit more later about where we've seen the most pain. So what's driving that increase? A big part of it seems to be coming from an increase in inflation expectations, and that can drive an increase in yields. And if you're thinking about what's driving those inflation expectations, I think the conventional wisdom is that with the new administration talking a lot about a big infrastructure program, especially if that comes with tax cuts, that could really increase fiscal pressures, and that could lead to inflation. A couple other things we've been hearing about, though, too. There's a question about what will restrictions on trade, if they come about, mean for inflation. They can have inflationary pressures, so cheap goods coming into this country, you could see a slowdown in those goods, and that could make prices rise in the U.S. But they could also put pressure on global demand, which would actually push inflation down. So that's sort of a contradictory pressure there. And then also, if you have restrictions on immigration, that could actually push wage pressures up in the U.S. There's a number of things going on here. I think one thing to point out is certainly among the managers we've talked to, some think that we've started to see this increase in yields as something that's overdone, that the markets are overreacting a little bit. And I think a consistent theme is that there's still a lot of unknowns related to the new administration and what policies they will ultimately take. And that just means volatility potentially in both directions for yields.
Do you think worries about the Fed raising rates is part of this as well, given their upcoming meeting?
Right. So I think, the markets had already kind of pre-election been increasingly pricing in the likelihood of a Fed rate hike, and I think we're looking at something like an 85%. The markets are predicting an 85% chance. So that's part of it, certainly at the lower end of the yield curve.
Let's look at some categories. What's done well, what hasn't done well? Is it about as you would expect?
Yeah, I think a lot of what we've seen is what you'd expect. So the biggest losses you're seeing are in the long-term bond, the long-term government categories, 5 and 6% losses since the election. These are very interest rate sensitive categories. They're really best used by institutions like pension funds, and they're not that big in investor accounts. At the other end of the yield curve, we're seeing short-term bond funds and ultra-short bond funds, which you'd again expect. These are less interest rate sensitive categories. Are doing reasonably well. Ultra-short funds are basically flat, and I think we've seen something like a 50 basis point loss on short-term bond funds. There are some other surprises out there, though, that maybe aren't quite as obvious. Emerging markets have done very poorly, especially local currency emerging markets funds. The dollar has been strengthening, so really even global funds with a lot of non-dollar exposure have had some trouble. And the other trouble spot has been in the muni market. Munis had actually been performing pretty well through the course of kind of 2015 and into 2016. There's some supply pressures there. Munis are rate sensitive, so that's clearly part of what's going on in that market. And then there are some policy questions outstanding. So, for example, if you saw a repeal of Obamacare, that could really mean problems for hospitals, and that's a big part of the high-yield muni market, which has done particularly poorly. Or if you see a slowdown in government spending, that could really hurt state and local governments as they try to make ends meet.
Looking at core bond funds, those intermediate term bond funds, have they kind of done better or worse? How are managers kind of positioned going into the election?
Right. So, you have a subset of funds that are neutral with relation to interest rates, and that's kind of a view that's very difficult to predict interest rates. But I would think for those that are making active bets, we've really seen the majority of those be bets to be short on duration. They just haven't seen value in going out the yield curve. So if you look at how the broad intermediate term bond category has performed relative to the Bloomberg Barclays U.S. Aggregate Bond Index, I think 75% of active funds are actually beating that index right now, just looking at the period since the election. So that suggests that those short, conservative views on interest rate risk are a big part of what's out there.
Some of this news seems, if not a little bit scary, certainly bond investors are not looking to take principal losses. They're holding it for different reasons. What's your advice to bond fund investors then? Is this a time to be worried if we do see more inflation, if we do see higher interest rates ahead?
Right. So first of all, I think it's important. Higher interest rates are ultimately good for bond investors, right? So if you were happy with your bond fund when you're getting 1.4% on the U.S. Treasury, 10-year Treasury in mid-July, you should be happier today. You're getting paid more. I don't want to minimize the risk of inflation, but the fact that yields are going up to help compensate you for that risk is definitely a positive. And I think, this is advice you hear a lot at Morningstar, but we really think that taking a long-term view is very important. Think about what role your bond fund plays in your portfolio. Think about, it's just very difficult to time markets, and that's true if you're talking about trying to time the interest rate markets or the equity markets. A lot of professional investors out there have had a hard time figuring out what direction rates are going to go in. So I think you have to be careful about doing that in your own portfolio. And finally, if you really are worried about inflation, there are ways that you can protect yourself. So Treasury inflation protected securities are a very good example. You should look at your existing bond portfolios because a lot of managers have liked TIPS over the last couple of years, so you may actually already have some exposure there, but there are obviously vehicles to get that exposure on a standalone basis as well, and you can get that pretty cheaply.
Sarah, I appreciate the overview today.
Thanks very much.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.